Check, please.
Hey guys, welcome back to Everything Money. In this video, we will revisit Amazon, this colossal company. They're having a stock split. They're buying back shares. We'll take a look at the financials underneath this company to see, is it a good buy even after a split? Make sure you don't get fooled by this marketing ploy. We'll go over to Stock Analyzer Tools, see what you should be paying with. And if you can trade this at a quicker pace, we'll have Mo show us how to trade it. I give you Paul Gabriel. Let's get after it.
All right, so first off, everybody needs to understand a very, very important thing.
Tell me.
The stock split does not change the market cap of the company. Stock splits are merely done to make lemmings think they're getting more shares and therefore more ownership.
Lemmings are a small rodent of some sort?
Yes, lemmings are a small rodent. So let me give an example that's very clear. Two companies each have a $1 billion market cap. I can make each of these companies have any price share I want. If I issue 1 million shares here, it's $1,000 per share. Why? 1 billion divided by 1 million shares. 1 billion market cap, I can have a $1 million per share with 1,000 shares. They're the exact same value. Right now, Amazon's selling for around $3,000 per share. You'll hear people say, I can't afford that. You might not be able to afford it because you can't afford one share. But what they're really doing, what the company's really trying to do, and by the way, it's actually beneficial for options traders because in options, you have to have 100 shares per contract.
Yeah.
But all they're doing is saying, hey, instead of a $3,000 share, we're going to split it 20 for 1. Now it's going to be $150 per share. You might sit there and say, great, it's cheaper. It's not cheaper.
It sounds cheaper.
It does sound cheaper. It makes people feel much more warm and fuzzy inside because they want to invest $10,000 in Amazon instead of getting 3.3333 shares. They now get, what is that? 66 shares.
Sounds beautiful.
Sounds wonderful.
Mm-hmm.
But it's not any different. It is no different whatsoever. I want to make sure everybody understands this very, very clearly. This is a very basic part of investing, but this is absolutely a fact. It's just done as a marketing ploy. Look at Berkshire Hathaway. Seth, what is Berkshire Hathaway's share price?
If I had to guess, it's around 420, but I'll look it up right now.
It's actually pretty much around, but look it up. I remember in high school, there was a kid a year younger than me. We were talking about Warren Buffett, and I said, yeah, I can't believe Berkshire Hathaway. What's Berkshire Hathaway at?
460.
484. So I remember saying to him in 1987, yeah, this stock is $37,100 a share. I still remember this like it was yesterday. He goes, no way. I go, yeah, it's $37,000 a share. We happen to have an Akron Beacon Journal newspaper. He looked it up. I remember him leaning over the table going, oh my God. Warren Buffett, if you go read about why Warren Buffett and Charlie Munger never split Berkshire shares is they wanted long-term thinkers to become owners. And their thought process was if it's a very, very nominally high-priced stock, very few people would be able to afford it. And the only people who'd be able to afford it are probably people who really believe in what they're doing and have a lot of money to wait for the long run.
People aren't going to swing trade this. It's not going to be incredibly volatile.
Correct.
The volume will be very low.
The average volume is like 70 shares traded per day on
correct.
Class A shares.
Correct. Yeah. And keep in mind, they ended up making a Class B share that's, a lot lower and blah, blah, blah. But when it comes to their Class A shares, they were very specific about why they didn't split the stock because they knew what splitting the stock would mean. It would allow for a lot more speculators and traders and things like that. They wanted partners, which is what they are when you buy a share of stock. You're partners with them. They wanted those people to be like-minded, long-term oriented people.
What's happening, I think, with this Amazon stock split is these young, maybe inexperienced new investors, if they finally wanted to be a partner in Amazon, this is an attractive entry price in terms of dollar bills, especially for those who maybe might be restricted by their brokerage or type of account where you couldn't have fractional shares. I'm reading this can help their employee compensation better by employees getting stocks. And of course,
why is that?
I think they'll be allowed to issue more of them, per se.
Yeah, I'm not following that.
Yeah,
and there may be a reason
maybe
why.
I'm not either, but
well, maybe they're not. Listen, remember, they're going to go do something and then tell the right story behind it.
I guess so. And then the final piece of this puzzle, Paul, is of course the share buyback program that they're doing.
Again, but their share buyback was announced on a dollar amount.
Yeah, it's true.
Right?
Yeah.
So they announced a $10 billion buyback.
What is this again?
$10 billion share buyback. They're buying back $10 billion of shares. If the average price is $3,000 a share, they have announced, what is that? So 1,000 would be 10. I don't even do the math. Is it 3 million? Is it 3 million shares? 3.33 million shares? I really hope so. Yes, it is. Or when it is now $150 a share, all they're doing is multiplying this by 20, 66 million shares. It's the same thing. It's the same $10 billion. And of course, it assumes the stock stays the same price for the entire buyback, et cetera, but it is no different. It is still $10 billion of stock bought back.
Yeah. I personally think a lot of the tech companies, I mean, you saw Google do it. I think it's for the same reason.
Tesla's done it. Apple's done it.
But the timing for Google and Amazon is different. Like they're getting, now tech is really starting to come down. What'll attract people that don't understand things to the market?
Well, it'll attract. So what they need to do is Amazon and Google need to attract people who were on the fringe, who weren't able to afford $2,000 or $3,000 a share, and now it allows them to afford it. So hopefully they're hoping it drives the price up.
There's a lot of people in the bid and ask when they do trading. They're like, I have to buy fractional shares of X stock. Amazon's one of them. No, they don't have to.
Exactly.
So moving forward, say that I do like this price. What about the investment, Paul? Is this still a good price to pay? Or that's the job on our show, is to show what we think about this company, and is it currently over or undervalued? Let's get after it.
So this is our Everything Money software. We're going to go to the 8 Pillars tool. We're going to type in Amazon. All right. Now, for those of you new to our software, we have real-time data software price changes. So as you can see, in the last 52 weeks, the high was $3,700 and the low was $2,690. And I believe that low was hit before they announced the stock split. So it is very interesting timing, right? Earnings come out. Okay, let's announce this little stock split after we're down 25%, right? I mean, we don't even realize this. This is the 25%, more than a 25% drop in Amazon share price, right? Okay, now let's go look at a 10-year chart of Amazon. If you had this at the very beginning, 10 years ago, $183 a share in March of 2012. You're up 15 times your money. That's incredible, even after the 25% drop. Okay, so let's go to our 8 pillars here. Now, here's the issue with Amazon. Now, guys, when a company buys back its shares, it's no different than the company taking its cash and investing in other businesses, right? So you want to make sure they're buying back their shares at a good value because they're taking the capital, the money that you as a shareholder have access ownership of, and reinvesting it for you. So if they're overpaying for a stock, whether it's theirs or somebody else's, they're not allocating their capital the proper way. Okay, so right here, they have increased their shares outstanding in the last 5 years. They just announced a $10 billion buyback. Okay, $10 billion is roughly 2/3 of 1% of their current market cap. Yippee. I mean, it's nothing. Their debt's pretty high relative to their free cash flow. 12 times their free cash flow. Remember, this company does not have a lot of margin. This 7.1% margin is not very big. Another thing, and I'd have to verify this, and somebody could verify it for me, Amazon does not make money selling goods. They're not profitable in that business. Seth, please verify that. It's been a very AWS, Amazon Web Services, has been their cloud computing business. That's been the big driver of their profit for a long time. So when I hear people say like Amazon, you can buy everything in Amazon, yes, and every single time you buy something, they lose money.
Yeah, their CapEx is insane with what they're doing for shipping and buying planes and buying shipments and trying to get things to your house within
ironically
2 seconds.
Look at their free cash flow. It is down $21 billion in the last 5 years. Now, granted, they could be investing in the future. I mean, Jeff Bezos, his goal is to have Amazon everywhere doing everything.
Yep.
They want it to be, okay, and by the way, I use it every day. Literally, I don't go to the store. I just buy off Amazon. Why? It's easy. And half the items I want to buy are available probably for overnight delivery.
Yeah.
What were we laughing about, Mo?
Before we did this video, I was like, oh, we're doing Amazon. I'm going to go to Amazon and see if my package was delivered. It was.
Oh, it was? You have no anger towards this shipping company?
Huh?
You have no anger towards this shipping company?
Because they do a good job and put it there when it's supposed to be there.
Guys, I love Mo. My father considers Mo a family member because his father and my father are friends for a long time. He's been friends with my brother for a long time. Mo and I have a new friendship and love for each other. Mo has this unhealthy anger towards shipping companies.
Specifically DHL and FedEx.
I mean, and he and our friend Matt constantly are talking about these shipping companies. And I'm like, you guys have got to drop it. Like, what's with the anger? You guys need to see a therapist. I mean, it's insane.
You can't even bring up the word FedEx around him. He's triggering.
It's this twitch that starts in Mo and he wants to kill someone. So that's what you find about.
Have you thought about speaking to somebody about your FedEx?
I only have 2 problems in life, and they're FedEx and DHL.
I mean, it's a good life he has, but it's literally this unsubstantiated anger. I have no problems with shipping. Do you have problems with shipping?
I was supposed to have something delivered to my house on Tuesday.
Here we go.
This morning, they send me a message and say, "Hey, your product just shipped out of China." I'm like, the hell?
Paul, you found it. Give it to me.
All right, so let me make this bigger. This is off of Investopedia. Look at my lab-created diamonds and the watch I was looking at.
Yes, there you go.
Amazon segment breakdown for the fourth quarter of December 2021. Guys, this is the fourth quarter. This is when everybody buys everything on Amazon completely. This should be their most profitable quarter shipping stuff. 3 segments. North America, percentage of revenue, 60%. International, 27%. AWS, their Amazon Web Services, 13%. That's their revenue. Here is their operating income. It is 100% from AWS.
Wow.
100% of their operating income comes from AWS. Now, the interesting part about AWS is it's not where they have the stranglehold. Google, Microsoft, all these people, Oracle, they're all entering this cloud base and making huge strides in it. The place where Amazon has its complete strangle on the market that they dominate is these 2 segments right here. These 2 segments, and it generates none of their profitability. Now, is there a business idea behind this? Probably. Do I understand it? I don't. Because to me, when you ask the average person, what do you do? What's on Amazon? They're like, oh, I buy my stuff from there. Yet it makes up 0% of their operating income. To me, that's a cause for concern. Okay? Now, going forward, back to the chart here, 5-year PE, 93.38, 5-year price to free cash flow, 131. Now they are growing like crazy. Let's go see how much the 5 years have grown in profitability. 3 billion to 33 billion. Again, all because of AWS. 10 years ago, they lost $40 million in a year. Okay, great. Free cash flow. So it is big growth in their on their profitability. Free cash flow. 5 years ago was 6.4 billion. Last year was actually a negative 14.7. Big CapEx here. Look at their CapEx, the line above. Negative 11.95. They spent 11.95 5 years ago. They spent $61 billion in capital expenditures last year. Before you invest in Amazon, I implore you, I beg you, I plead with you, go understand what they're spending their CapEx on. It is so important to understand because whenever a company has big CapEx, they're making some bet on the future. Go make sure that bet on the future is going to pay off dividends. Big, not literal dividends in terms of a check, like in terms of the metaphorical dividend. You need to make sure they're deploying their capital in the proper way. Because when I hear $10 billion stock buyback at valuations like this, it makes me a little apprehensive.
They're paying too much for their own stock.
I believe so.
So if this methodology speaks to you at looking at the numbers, you can have the software in the palm of your hand on your phone right now behind Paul. Paul, tell them how they get it.
So guys, when we first started this channel 2 years ago, one of the most common questions we got was, how do I analyze companies the way you do without waiting for you to make a video? Because I was using Y-Charts, which is a great service, but very expensive. So we invested hundreds of thousands of dollars and constantly invest multiple 5 figures every single month in our software. You get everything you've seen so far. You get the 8 pillars, retirement calculator, stock analyzer tool, which you'll see right after this, analyzing Amazon, 8-pillar portfolio, exclusive video content. Every single day we release videos only for the users of our software and our app, because this is all available on our mobile app as well. You get a watch list, which is coming out very shortly. You get real estate calculator moment. All these things that are coming out soon, you get as well. But most importantly, guys, you get this, the EM community, because the most common thing we heard, And the most common thing we all experienced was we felt alone being value investors. We were ridiculed. We were told you don't get it. But in this community of over 6,000 people, we can now have conversations and have like-minded conversations. Today, Alibaba is down 10%, and people are talking about it because it's a big holding of ours. And it's a value play that we truly believe in. So this community allows you to go in there, have conversations. There are 2 ways to sign up for Everything Money's software, everythingmoney.com or Patreon for our international users. The benefit to everythingmoney.com directly is you don't pay sales tax yet because we're not big enough. Guys, if this could increase your returns by 1 or 2% a year or decrease your losses by avoiding the big losses by 1 or 2% a year, this will reap hundreds of thousands, if not millions of dollars in your retirement. No brainer, $1 per day, less than a cup of coffee is what this costs. And whatever price level you sign up for, as we increase the price in future months, you're stuck at that level. You stay at the same level. No brainer, go sign up. So now,
The most popular tool, Paul, is Stock Analyzer.
now the most popular tool is our Stock Analyzer tool. And I'm going to go pull up Amazon. Now, what this allows us to do, guys, we don't know the future, but every investment is the present value of all future cash flow. So we have to estimate the future. Now, let me show you guys what the analysts are saying out there. All right, guys, so this is Amazon. I have pulled their next 9 years of estimates from analysts. Now, guys, if you watch this channel, you know I take analyst estimates with a grain of salt. I'm going to show you a little bit here. Okay, still do your estimation, but it's a very popular thing to just get a gauge of where everybody's at. In the next 10 years, here are the EPS estimates for Amazon by year. Starts at 49, ends at 285 in 2030. So at $285 per share, if this is 100% fact, let's say God comes down right now and says, this one analyst, and by the way, keep in mind, look how many analysts as years go on, 40, 40, 13, 5, 5, 5, 1, 1, 1. But if this one analyst is right, $285 a share, and you multiply it by 15 for a PE of 15, you get $3,475 per share as a value. 10 years from now, and it's currently selling for $2,700, $2,900. It was selling for $3,700. That's the one estimate. Now, the one thing I want you guys to see is go to 2027. Look at the big difference in EPS from low and high. This shows you the low and high estimates. Guys, these are double in a lot of areas. Next, for last year, the estimates were between $34 and $68. For 7 years from now, the estimates range from $150 per share to $323 per share. Now, if I was blindly looking at analyst estimates, as a conservative investor, I'm going to go in the low end of those estimates, okay, and see where the stock is selling. So right now, in the low end of 2027, $150 a share, the stock is selling for about 20 times earnings on the low end of the estimates. It seems a little rich still. You have to grow into that value. That's still a long time to wait to get to, that's basically where we're at right now, right? I don't know if I like that very much. So that's my opinion. Now, revenue-wise, here are the estimates for revenue. In year 2030, the estimates are $1.58 trillion in revenue. A low end estimate of 1.1 trillion, high estimate of 2.25 trillion. Those are big estimates. That's a half.
That's
Do you see this?
Holy
But
crap.
that's my point, guys. Every analyst is different.
Jesus.
Every analyst is different. Now, these 3 analysts, everybody thinks they're going to be a $1 trillion company in revenue. They very well could be. But look at 2025, $750 billion and $915 billion in revenue. That's a much tighter revenue range. Okay, so we're going to be putting these estimates, we're going to get a data feed soon for Everything Money software, which is why you should sign up now, because when those estimates come out and they're very valuable, you're still going to be stuck at that $1 per day. So sign up now. But either way, this is an estimate. So let's go back to Stock Analyzer tool. Let's look at his revenue numbers. Let's go with, I'm going to go 7, 9, and 11. Let's go 7, 10, and 13% revenue growth. Profit margin. Let's say they keep doing AWS. It keeps growing like crazy and it's big margin. Let's sit there and say 6, 8, and 10% profit margin. Free cash flow margin. I'm going to actually go with the same number. PE. Now here's where everybody's going to get mad at me. 13, 15, 17. Remember, guys, the bigger the company is, the lower the PE. You should be willing to pay a higher premium for companies that are growing like crazy. When it's a 1 trillion revenue company, it's going to be harder to grow and grow and grow. I do a 12.5% return to provide for margin of safety, and you can always buy an ETF for 9 or 10. Hit the analyze button. Guys, we have a low of 850, and a high is still assuming the highest revenue growth numbers that I put in there, it's still not even worth what it's worth today. If I want a 12.5% return. Now, here's the cool thing about our software. You can hit a plus mark to any of these, add this company to your watch list, or go to the top, add to your watch list, add notification. I want a notification when Amazon falls below 1,500, notify me, it's on there. And you'll get an email and a notification in your app to let you know, hey, Amazon just fell below 1,500, go take a look at it. So that's where I stand on Amazon as of right now. Now, that doesn't mean that this is the end for it, because when they split, it'll be much more open to trading, and that's what Mo does.
Mo, what's going on? I'm sure people day traded this stock today.
Well, remember, it's hard to day trade this stock because it's
$2,600,
$3,000, yeah, whatever it is per share. So for right now, I'm going to look at it from right now, because this is when this becomes $140, $150, whatever it is, then this is going to get a lot more volume and a lot more activity. So right now, looking at this from a long-term perspective, I mean, they are holding a very strong support level that they've been holding for a very long time. And this is a lot of room to fall with not a lot of support in this channel. So I really see them coming, whatever the equivalent of just under, I don't know, $1,900 a share, whatever that is the equivalent of, that's where I see this thing going from a long term. So if I was you, I would put this on a short-term, a long-term watch list.
We'll see you next video. Join the community, get the software. You will love it. Final thumbs up, subscribe. See you next video.